Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. Today, we're going to talk about the Uinta Basin in Utah and talk a little bit about the geology, the major operators who are drilling some horizontal wells there, and what the future might hold for that area if you have minerals or royalties in the basin or looking to invest there. And like the others that we've covered in previous episodes, if you have any interest in the Powder River, the DJ Basin, or the Permian, we have episodes that provide an overview on those particular areas. So definitely give those a listen. Before we get started, I just want to say hi to Justin Williams, who's here with me today as well. Hey, Justin.
Hi, Matt. Thanks for having me as always.
Thanks for coming on the show. And before we get diving into the details here, do you want to read the latest review that we received?
Absolutely. And this is from CPA A Go-Go, which is a wonderful name for a CPA. It says, I've worked in the oil and gas industry as an accountant for about 12 years. The podcast has really helped me to connect how mineral rights and accounting work and how they fit together as an accountant. Even after working in the industry for this long, I learn something new in every episode of the show. Keep it up. Great work. And thank you so much for the review.
Yeah, thanks for that 5-star review. And like CPA A Go-Go, definitely appreciate it if you could go out onto iTunes and leave us a rating and review. It is really the one way that you can give back to the show if you've gotten any value out of this. So it helps us get the word out to others that need to hear the information. So we'll go ahead and get started. Justin, do you want to talk a little bit about the location of the Uinta Basin and some of the counties where it's located?
Absolutely. So it's a geologic structure based and located in northeast Utah, east of the Wasatch Mountain and south of the Uinta Mountains. First gas production was established in 1925, and oil was discovered in 1948 at Ashley Valley. So majority of production comes from Duchesne County and Uinta counties, but also includes Wasatch County, Carbon County, Emery, and Grand counties. The largest population centers in the basin are Price, Utah, in the southwest part of the basin, and Vernal, Utah, in the northeast part of the basin. A large percentage of the surface and minerals in the Uinta are held by the federal government currently.
Yeah, and just to break down some of the statistics, I pulled this up in the Utah Department of Natural Resources, the Oil and Gas Division, just to take a look at the production by county. And the top 3 counties for oil production in 2018, the top was Duchesne County with around 19 million barrels of oil total. The second was Uinta County at around 12 million barrels. And then San Juan County was a distant third at about 3.9 million barrels. For gas production, top gas producing county was Uinta with about 187, almost 188 million MCF of natural gas. Duchesne was about 42 million MCF, and Carbon County as well was around 42 million MCF. So Uinta, definitely the hotbed of activity and production from both gas and oil. Duchesne as well from an oil perspective. I'll dive into the geology. And if you look at it in a map, usually what you'll see with the Uinta Basin is often thrown together with the Piceance Basin, which is just across the border in Colorado. These two basins together are sometimes referred to as the Uinta Piceance Province when talking about oil and gas. The two basins are both laramide structures, and they're separated by the Douglas Creek Arch in the middle. And another interesting feature is that both basins are mostly bounded by major faults. Uinta Basin consists of both conventional oil and gas resources as well as unconventional. And we've mentioned this several times on the show, but when we say unconventional, think of tight sands and shales. And so any unconventional resources is usually are more continuous in nature. And so we'll focus a lot of what we're talking about today on the unconventional potential there, because that's really where the upside is and where most of the activity is focused. As we've mentioned before, conventional oil and gas reservoirs have discrete geologic features which provide a structure for oil and gas to accumulate. In other words, a trap for that stuff to accumulate. Usually it's more hit or miss. Historically, this is where oil and gas was found, and usually vertical wells were drilled. There is the potential for dry holes. So you kind of hit or miss, where you're kind of poking holes in the ground and you hope that you hit a trap in a reservoir where there's oil and gas that's pooled. Unconventional formations, like I mentioned, are usually more continuous in nature and allow for horizontal drilling. And usually there are much lower permeabilities and lower porosity, and there's not obvious seals and traps like the conventional reservoirs. In the past, these weren't economic to drill. They wouldn't flow on their own. So this is where the advent of hydraulic fracturing came in. Wells can be drilled horizontally and then fracked to kind of create some fractures, like it sounds, in the rock to allow oil and gas to flow to the wellbore. So, according to the USGS, nearly all of the undiscovered gas is estimated to be in continuous unconventional reservoirs. And so, if you look at where they break down the estimate of where that resides, 21 trillion cubic feet of gas and about 59 million barrels of oil and 43 million barrels of NGLs are total estimated to be in this province. And the breakdown from the 21 TCF of gas, 13 TCF is estimated to exist in the Mesa Verde formation, and then 7 in the Mancos Maori system. And then there's some others that make up the small remainder. And then for oil, 65% of the estimated oil potential is in the Green River total production system in the deep Uinta Basin. And the remainder is estimated to be in conventional oil and gas reservoirs in the Green River and the Phosphoria total petroleum systems. So we're going to focus mostly what we're talking about today on that Green River total petroleum system. This is where the overpressured layers exist in that deeper northern and eastern areas of the Uinta Basin, especially around the Altamont and Bluebell field in the north part of the basin. And interesting thing about the oil and gas production here is that most of it is within tertiary rocks. So when you think about stratigraphic column, looking at all these layers stacked on top of each other, tertiary is on the top. What makes this unusual is that this is, some of the youngest rock. And so that's not typically where oil and gas is found. But here it's made possible by both vertical and then lateral migration of oil and gas from the original source rock in the deeper part of the basin. And some of the physical evidence that they've seen that kind of proves this is extensive occurrence of tar sands that exist in outcrops, which is tar sands, like think of solid bitumen, just like it sounds. And this is in the central part of the basin where that exists. And so they've seen where kind of geologic evidence of oil and gas migration vertically, and so when we talk about tertiary rocks, these are actually pretty deep though. So we talk about where some of this overpressured these formations exist. It's mostly deeper than around 8,500 feet. And then, like other oil and gas plays, there are multiple stacked horizons. And so we've mentioned this with the DJ Basin, the Powder River Basin, and the Permian. We have multiple layers where there's oil and gas that is found. And in the Uinta Basin specifically, though, horizontal activity is still at very early stages. There's when you look at comparing the number of horizontal wells that have been drilled in the basin compared to some of the others that I mentioned, is just still just a fraction of it. So they're figuring out, where it's going to be economic to drill, where the best product exists. We'll talk here in a second about the type of oil and gas. And one of the things that is interesting about the Green River oil production is it's mostly waxy crude. So it's got a very high paraffin content. And what that means is will basically solidify at room temperature. So it has to be heated up or maintained at that kind of a temperature, at least about 100 degrees or 120 degrees Fahrenheit, in order for it to flow. And so that's one of the unique properties of the oil produced from this area. Now, I'll talk specifically about the potential oil and gas formations from top to bottom. And I'll tell you kind of an interesting tidbit here as well. So, first is the Green River Formation, which includes some of the kind of main intervals that are being targeted right now. You have the Green River itself, the Mahogany Oil Shale, Douglas Creek, the Black Shale, Castle Peak, and Utland Butte. Interesting fact about the Green River Formation is that it contains the world's largest oil shale deposit with around 1.2 trillion barrels of oil in place in shale and marlstone. Now, this is different than the shale formations that they're producing from, in the Green River itself, as well as in other unconventional reservoirs around the country. This is actually kerogen. So this is immature source rock, basically, that were not buried deep enough to have generated hydrocarbons. And one of the most well-known deposits is in that Mahogany oil shale zone that I mentioned. And that's primarily located in the Piceance Basin, just across the border in Colorado. And this source rock, this oil shale, basically wasn't exposed to high enough pressures and temperatures and time to break down the kerogen into oil and gas. And I actually worked when I was working for Shell on an R&D project in Northwest Colorado, looking at how to heat the oil shale up below ground to produce it. And this is when the price of oil was above $100 a barrel. And there was a lot of interest from companies in trying to crack the code, no pun intended, in trying to accelerate the process by heating the oil shale to produce this synthetic crude oil and gas. They did this back in the late 70s and early 80s, as some of you may remember, with traditional mining methods. So they would do kind of room and pillar mining with big trucks in there, take it down out, above the ground, and put it into a surface retort furnace, try to heat it up. They would get a lower quality, almost like a tar out of it, but they would get a crude type product out. Wasn't very economic, had to put a lot of heat in, a lot of energy to get the oil out. Then technology was developed to insert heaters into the ground to basically do this process below ground and actually accelerate that natural process of thermally cracking the kerogen to get it to produce oil and gas. And Shell did do a demonstration project. They did produce some synthetic oil and gas, created through the process of heating it over a period of time. But again, it's just one of those things. It's not economic. A lot of energy has to go in to get that, and then just a lot of technical issues as well with trying to do it versus the unconventional resources that were discovered right about the same time. So that was proven to, that proved to be really the way forward, was to develop, all these formations that we're now drilling horizontal wells and fracking and shale formations and tight sands. And so just a tidbit there about this particular area, in the future, who knows, maybe when we run out of all the unconventional oil and gas and all the secondary and tertiary recoveries been exhausted, and we need, if we still are using hydrocarbons, then maybe this will be something that will come around again at that point. But for now, it needs to be oil price needs to be much higher before that becomes economic. So back to the regularly scheduled program here, we're talking about the different formations. A couple more to mention here. The Wasatch Formation, and here the production is mostly yellow waxy crude. Then the Mesa Verde, which is mostly a gas play, and it can be either dry gas or liquids rich, depending on where you are in the basin. And then finally, the deep Uinta, which includes the Blackhawk and Mancos and Dakota intervals. So just again, from top to bottom, Green River Formation, Wasatch, Mesa Verde, and then the deep Uinta. And the horizontal activity right now is currently focused on the lower Green River and the Wasatch Formation. And so that's what we'll talk about here. So, Justin, you want to take it away and talk about some of the major operators and some of the risks associated with the basin?
Sure, be glad to. So some of the major operators, it used to be three major players, EP Energy, Newfield, and Crescent Point Energy. Several of the operators with the largest positions in the basin have recently sold their interest. Crescent Point Energy sold their Uinta asset in 2019 to an unnamed private operator, and Canada acquired Newfield and the Uinta asset, but it has been a footnote on the investor presentation ever since, with Encant focusing on Anadarko and their Permian acreage. EP Energy is seemingly the only major player that is touting their Uinta Basin position, reporting some interesting horizontal well results from long lateral horizontal wells. Word is that Oxy is stopping their Uinta asset that they acquired in the recent Anadarko deal, so it will be interesting to see what they decide to do there. Some of the economic risks, like we've always talked about and mentioned before, there's always a level of economic risk due to the fluctuating commodity prices. Wells currently are economic to drill at oil prices around $55 to $60 a barrel and $2.50, which is the natural gas. If prices drop significantly, we could cause a slowdown or stoppage in drilling new wells. The high paraffin content of the Uinta crude oil contributes to higher transportation and refining costs. This is because it has to be kept hot in order for it to flow, like Matt mentioned. So a lot of the equipment must have heaters, all that fun stuff. Well, break-even prices are marginal in the current 55 to 60 WTI price environment. Because of the focus on capital efficiency and companies living within their cash flow, marginal plays like the Uinta are likely to see a reduction in investments versus other areas that have the infrastructure, have shown and proven development and the ability to produce. Newfield and Crescent Point, which used to be two of the biggest operators in the basin, even before selling, have indicated that they were spending most of their capital in other plays like the Permian Basin. What this means is that the production will likely remain flat or even decline slightly going forward unless oil prices rise above $60 a barrel or unless operators can get drilling and completions costs down.
Yeah, I was going to say that, it's interesting to see that, despite some of the interesting well results, it's still young and there's not a lot of history here. So I think a lot of operators are just playing it safe. And because, like we mentioned, some of the issues with having to keep the product hot and just the characteristics of the oil that's produced and the depth and the cost, it's just not economic to go full bore and start to drill a bunch of wells. So they're just really in still exploration mode, I think. So it'll be interesting to see if EP Energy, like Justin mentioned, kind of the only one that's out there that's advertising the fact that they're drilling Uinta Basin wells and that they're getting some good results, and see if they maybe can crack the code that might cause some of the other operators to come back in, again, once oil prices recover, or maybe as long as they stay the same, as long as maybe EP Energy can get their drilling and completions costs down.
Absolutely. And political risk, of course. Utah is a pretty conservative state, mostly favorable to extractive industries. All that could change if out-of-state special interest groups decide to come in and influence legislation. That said, risk of this is pretty low since Utah isn't a major oil and gas producer, and level activity is relatively small compared to other parts of the country. So if environmental groups are going to spend energy, it will likely be where they feel they can get the biggest bang for their buck. Quote from John R. Baza, Utah Director of Division Oil and Gas and Mining. The mining of coal, minerals, oil, and natural gas production play an important part in Utah's economy, and without these natural resources, we cannot enjoy the standard of living we do in our modern society. The Division of Oil, Gas, and Mining ensures our access to these natural resources in an environmentally responsible manner, while our abandoned mine program works to protect the public from the dangers of unregulated past mining practices.
Yeah, so I think that just goes to show how favorable it is, in that, unlike Colorado, with the recent changes to the Colorado Oil and Gas Conservation Commission, being that they're now going to focus on regulating the industry and focusing on protecting health and safety. Here, the director is actually recognizing or acknowledging the fact that all the good stuff with respect to the economy, or a lot of that, is due to the fact that we have these natural resources that give us the standard of living to enjoy like we do. So I think, to me, that just shows how favorable the environment is there.
Absolutely. And that always helps to keep the oil and gas companies interested, of course, because hassles in doing business is never what they're looking for. Some geologic risks that comes with this area. Higher risk area because it's relatively immature horizontal oil and gas play. We spoke a little bit about that earlier, but there's just right now other areas that they can get more bang for their buck. Waxy content inside the oil can be problematic. Success will likely be isolated to thermally mature parts of the basin where oil and gas reservoirs are overpressurized. Issues are that many of the wells are deep, so can present issues when they're drilling, more opportunities for operational issues as they go. Some infrastructure constraints, also because oil produced in the Uinta has a high paraffin content. It's harder to transport, like we mentioned, because it solidifies into solids. Most of the Uinta Basin crude oil is trucked via ice-insulated trucks to local refineries in Salt Lake City. Because of the high paraffin content, only certain refineries are set up to process this, so there's a bit of a refining constraint to getting that to market. Marathon operates the largest refinery in Utah with total crude oil refining capacity of 61,000 barrels per day. Chevron refinery around 55,000 barrels per day. Holy Frontier Woods Cross Refinery in North Salt Lake City around 39,000 barrels per day. And then Big West Oil Co. around 30,500 barrels a day. Total refining capacity in SLC is around 185,500 barrels a day, which is relatively small, but only around 88,000 barrels a day of that is wax crude refining capacity. So there's somewhat of a cap on the local refining capacity. And, if more was drilling, they may develop that, but that could be an issue getting into market. Rail terminals would likely be the way the operators would like to look to expand to get their product to market. Around 60,000 barrels a day capacity of rail is available today. To put that in perspective, a Motiva refinery in Port Arthur, Texas is the largest in North America with around 600,000 barrels a day capacity. So you can see that what's going on there is a bit small right now.
Yeah, so I think, like Justin mentioned, there's sort of multiple factors. Again, it's sort of like the field of dreams analogy. If you build it, they will come. So I think if operators are coming in and drilling the wells, then they'll come in and put in the infrastructure to be able to transport the oil and natural gas out of the basin, whether that is through additional rail terminals to continue to have rail transport or local refining capacity upgrades. Will be interesting to see what happens. I mean, a new refinery hasn't been built in the U.S. in decades, so it's more likely that they would look to expand the rail capacity to get product to other refineries that have the capabilities to refine waxy crude. But really, there is a baseline level of infrastructure in place because, like Justin mentioned earlier, oil and natural gas have been produced there for decades. It's really just a matter of scaling that up. Should somebody come in and find a way to drill wells economically in the basin? So anyway, that wraps up our overview of the Uinta Basin. I want to give a special shout out to Tom Moore, one of our longtime listeners, for suggesting this. So let us know if this has been a helpful overview. And also, if you have any other suggestions for topics, reach out to us. And you can do that by email at feedback@mineralrightspodcast.com. I'll have links in the show notes you can find at mineralrightspodcast.com to some of the articles and some of the figures and maps associated with the Uinta Basin. So be sure to check that out. And as always, like we mentioned before, please subscribe to the show wherever you get your podcasts and leave us a rating and review, hopefully a 5-star rating. If not, send me an email and let me know how we can improve. So thanks again for listening. Thanks, Justin.
Thanks, Matt, for having me.
And we'll talk to you next time.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.